PayPal reported earnings, and so far I have been right on my thesis from my last video that investors need a reason to buy PayPal. There has to be something or someone that could cause a change in sentiment in PayPal, and I said this will most likely be the CEO, and this was his first conference call. I think it went amazingly well so far. He talked about profitable growth and many other things that PayPal should have been talking about for many years, not just growth at any price. Or I mean, the CEO seems pretty well. So far, PayPal is up, I believe, 6% pre-market, but this is a crazy market. Maybe by the time I upload this video, it's down 6 or 7%. But so far, things have been playing out in terms of a change in sentiment around PayPal. It's too early to tell, which is why we're going to keep focused on fundamentals. I'm going to update you on them in this video, update you on my valuation model, and just tell you what I think about PayPal's earnings and what I'm looking at the stock in general. Now, looking at the EPS, they did beat on EPS over a 5.7% beat. They also beat on revenue. It was pretty good. Again, I'm not seeing any signs of a dying company or a Kodak or whatever people are claiming in some videos. PayPal does not look like a dying company to me whenever you have payment volume increasing. I mean, it's just crazy. I mean, I don't know why people are saying PayPal is dying. I'm not seeing it. People are still using PayPal. Volume is increasing. Yes, net active users are decreasing a little bit, but this is because they are entering in other ventures. They are still very high so far, something like 470 million people. This is not a sign of a dying company. I mean, that's at least what I'm seeing with my own eyes. Looking at margins, I mean, margins have stabilized, which is good. I was a little bit concerned in my previous videos, as you know, around the non-GAAP operating margins because it was declining pretty much every single quarter, where it has taken a shift this quarter, not just in non-GAAP, but also in GAAP operating margin. Again, massive difference. I'm going to tell you why later in the video. But so far, operating margins have stabilized, and I'm happy to see that because it was kind of reflecting on my thesis a little bit. I'm like, if operating margins continue to decline, then I might have to change my mind on the stock that something is not going right. But they did cut a lot of expenses to maintain the operating margin, and this is good for them. But this is something we have to monitor over the next few quarters to determine the trend, because maybe they cannot cut any more expenses, and if they're gonna continue declining in operating margin, then this could potentially be some kind of a concern for PayPal. Now, looking at the non-GAAP EPS, it has been doing amazingly well. It grew over 20%, year to date over 25%. Again, this is not a sign of any dying company, in my opinion. Over $1.30 of EPS. It was $1.08 in 2022. Now, I know what most of you are gonna say, and this is mainly around the stock-based compensation. And I do 100% agree with you, because if you look at the difference between the GAAP EPS and non-GAAP EPS, it's huge. So if you're valuing PayPal on a EPS normalized or non-GAAP EPS, PayPal right now is trading at something like 9.7 times earnings, which is extremely undervalued. But if you value it on a non-GAAP EPS basis, PayPal is trading closer to something like 17 or 17 and a half times EPS per share. And this is a huge difference between 9 times to 17 times. But even 17 times is still somewhat undervalued at a $55 per share for a company like PayPal. But one of the reasons for this massive gap is the stock-based compensation, and PayPal's management has not been very honest with these numbers. I mean, I'm not a big fan of that stock-based compensation stuff, but a lot of the tech companies do it. Adobe does it, so you have to be careful with Adobe. Enphase is huge in doing this, and SolarEdge, and it's just been crazy, especially with the solar stock. SolarEdge is absolutely insane. I mean, there's like, it's double the EPS non-GAAP and GAAP. It's crazy. So you always have to pay attention to that stuff, and we're going to use both GAAP and non-GAAP, and I'm even going to give you a valuation model of PayPal, where if it doesn't grow revenues at all, what kind of returns you could expect from today's price. So this is going to be pretty interesting. Now, in terms of the capital allocation, they have been doing a lot of share repurchases, not much CapEx, not much acquisition, 2023 year to date. This has been the right move for PayPal in 2021. Whenever the stock was skyrocketing, they were doing more investments and acquisitions. They were not buying back much stock. But then in 2022, the stock started crashing, and they increased the buyback program. This has been very helpful for PayPal shareholders. You could see the kind of average shares outstanding on a quarterly basis. They have been coming down. since pretty much the early 2021. Now it's 1.1. It used to be 1.19. It's not the best buyback program in the world. It's not the biggest buyback program because you have the stock-based compensation offsetting a lot of the buybacks that PayPal is doing. So it's not like if they buy 4 billion, I mean they buy the whole 4 billion, because they are also offsetting some of the dilution that you experience from stock-based compensation. But it's not bad in general, and it's ultimately going to create value to shareholders over the long term. Looking at their fiscal 2023 guidance, in terms of revenues, it's only 7.5% to 8.5%. Now, before in my valuation models, I had around 9% to sometimes 10% revenue growth. So I revised it a little bit down in the video. I'm going to use the latest 7% on spot, just to be a little bit conservative with the valuation model. Free cash flow, at least $4.6 billion. Share repurchases, over $5 billion. CapEx, only 3% of revenue. Very, very smart. They're focused pretty much everything on buying back stock. And this is what the management and this is what PayPal should be doing here from now. First, I'm going to give you my valuation model that's based off some growth numbers. And after that, I'm going to give you my valuation model to determine what kind of return we can anticipate if PayPal has 0% revenue growth in the future, because a lot of people are claiming that PayPal is a dying company. So I'm also going to assess the company on 0% revenue growth. Now, in terms of revenue growth, I used just 7% here in the video, even though I used 9 and 10 in my previous ones. But based on the latest guidance, they put up 7.5% spot. If we want to be conservative, we can use 7%. I think 7% is pretty fair. This would come up to $7.5 billion of net income using their 18% non-GAAP net income margin. I'm using non-GAAP here in the video. It's simpler to use and Wall Street uses it. So I'm using non-GAAP margins to value PayPal. You could do the same thing on GAAP margins. You're likely going to come up with some kind of a similar results if you're using the GAAP margins and non-GAAP in terms of an upside potential. But I'm using the non-GAAP margins here for a PE ratio. I'm using 15 times normalized earnings. Now, the current multiple for PayPal on normalized earnings or non-GAAP is something pretty close to 10 times multiple. Now, for me, no matter what kind of a dying company PayPal is, with such margins and with still decent growth, 7.5 to 8.5%, I think 10 times earnings is extremely undervalued for a company like PayPal. And I would personally expect the market, uncertainty to kind of get, less and less uncertain over the future. And I would expect PayPal to get back to 15 times earnings. So I'm pricing in some kind of a multiple expansion. So it's risky sometimes when you do that, which is why I have my other valuation model I'm going to show you. But I believe 15 times earnings is conservative for something like PayPal if PayPal is still growing 7, 8, or even 10% revenues every single year. So using 15 times earnings and a 3% buyback yield, if they buy back 3% of the market cap, I'm getting around 116% on the upside, or 16.6% CAGR over the next 5 years, which is not bad at all. Now, if I want to double my money with PayPal, I would have to buy PayPal somewhere around $55 per share. On pre-market, it's around $55 per share. I would personally expect some kind of a double on the stock over the next 5 years, or pretty close to a 15% return over the next 5 years, which is amazing, in my opinion, for something like PayPal. And I have to remind you that I was pretty bearish on PayPal whenever most popular YouTubers started buying it. They started buying it around 120, 130, and I made 3 or 4 videos. You go back and watch them. And I said that PayPal just looks overvalued. We're entering a recession that doesn't make sense. And the multiple was expanded. But I changed my mind whenever PayPal got to around $61, $62 per share. Now we're sitting at 55. I don't know where we go from here, but this is my assessment in terms of growth numbers. Now, if I want to price in PayPal to assume that PayPal is not going to grow at all, I mean, it's pretty simple in my opinion. I actually had it pulled up here. I can pull it up again very quickly, and I'm just going to go to the stock-based compensation expense of PayPal, and I'm going to try to get the free cash flow without the stock-based compensation. And if we look at the pretty much the stock-based compensation for 2022, it was something around 1.2 billion, and it has been declining. So I'm assuming it's going to be the same for 2024 and beyond, around $1.26 billion of the stock-based compensation expense. Now, in terms of free cash flow, this is something like 4.6 billion. Now, 4.6 billion, if I take something like pretty close to 1.3 billion, I'm getting something like a $3.3 billion in terms of a free cash flow yield without including the stock-based compensation. Now, if I'm getting 3.3 billion, as a market cap is something like 56 billion, this is pretty close to a 6% yield on PayPal, free cash flow yield without using the stock-based compensation. So I would personally expect that if PayPal faces no multiple expansion or contraction, 0% revenue growth, I would expect a return to be closer to the free cash flow yield excluding stock-based compensation, which is something like a 6% return every single year from a $56 billion market cap. So the worst case scenario, if PayPal does not experience a further multiple contraction, which I'm not saying how this is going to happen, is the multiple is already very low. I'm not saying how PayPal is going to decline in revenues. It's still growing 7 to 8%. So if it just stays flat, everything stays flat, I'm saying some kind of a worst case scenario of 6% return every single year, a base case scenario of a double of 15% every single year, and there could be more upside in the future if the multiple goes to 20 times, which I don't see why it would go to 20 times, or if maybe they grow revenues 20% again, they enter some kind of a new venture or develop some new products. But I think between 6% to 15% from here, this is my kind of fair value on PayPal. This is my honest opinion on the stock. I don't know where the stock is going to be when I upload it. Maybe it could be 45 or 48. I mean, who knows in this crazy market. But this was my opinion on PayPal. It was not financial advice. I hope you enjoyed the video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.